Hi, everybody. This is Alex Fensky with the Chicago Southland Homes team at Keller Williams Realty. And today is September 6th. We're bringing you the August 2023 housing market update. And some of the most surprising news that I'm going to talk to you about in this month's update is relating to prices as well as to mortgage rates. I'm going to have a told you so moment as well. So keep watching and we'll get to that pretty soon. What I'm going to do is I'm going to go through some regional level information for the Northeastern Illinois or Chicagoland housing market as it relates to residential real estate. So houses, condos, townhomes. Now, you have to be careful what news you listen to for real estate, because the stuff you hear at a national level, there really is no such thing as a national real estate market. I mean, you can make measurements, but there are places that are so incredibly different from one another. It's meaningless to someone who's curious about what things are like for their area. Even the stuff that I'm going to go through, which is a lot more accurate and relevant than anything you'll see at a national level, is still for an entire metro area. So as I always say, contact me for specialized advice about whatever your circumstances or scenario is, and so that I can give you specific advice about your area, your goals, your property, or the property that you're looking to buy. So with all that said, let's dig right in. We're going to first cover supply, then we'll talk about demand. We'll talk about how the two relate to each other, prices, rates, and what to do about it. Starting with supply, we're going to take a look at new listings first. So I'm going to go to my new listings chart here. I'm going to move my face around so you guys can see the graph. So with new listings, if we're looking at this data point right here, that says that there were about 14,600 new listings in the month of August, and that is 15% fewer than the number of new listings in August of last year. So August 22, we had over 17,000 new listings. Now, right now, we're looking at a 3-year chart, but you can see if I back it out to as far back as our numbers go, this is absolutely the lowest August dating back to 2008, which is as far back as this tool goes. So supply is absolutely down. That's new listings. Now let's take a look at the number of homes that are for sale. So as of the end of August, let me zoom in a little bit here. Here we are, just over 16,000 homes for sale. Now you can see that it's hovering right around. It's not exactly at record lows right now, but the bottom record low number was 14,981 in April. So right about 15,000. We're still hovering around 16,000. And in the grand scheme of things, this is extremely low and basically record low inventory. If I use a rolling 12-month average, which sort of eliminates the effect of seasonality, you can see the trend is still very much downward in terms of the number of homes for sale. So overall, the number of homes for sale continues to decline. And that's a combination of how many are being put on the market and how many are being taken off the market, primarily by people buying them. So what's weird about this is that typically, if I go back to the monthly data, typically every August, by August, inventory has grown by 20 to 40% from the number of homes that were available at the beginning of the year in January. But in this case, we actually ended August with fewer homes than were for sale in January. So in January, there was 16,700. Now there's fewer than 16,300. This number should be 20 to 40% higher based on typical trends. So we are still seeing some things that are not in accordance with our customary seasonality, the stuff we normally see as those changes develop throughout the year. So supply is absolutely down. Let's take a look at the demand side now. First, we'll start with pending contracts. This is the number of homes that were under contract at the end of the month, and it was just over 10,000. That's down about 7.6% compared to last August. So it's still down over the same month of last year, but it's starting to flatten out. Again, if I look at that 12-month curve, the rate of decline is starting to lessen. So it's falling less fastly, if you'd like to call it that. And right now, if I zoom out and look at the 10-year chart, you can see that right now we are right around, in terms of pending contracts, right around where we were back in 2013, which was the initial portion of the recovery after the Great Recession. So that number in January 2013 on a 12-month rolling average, it was 107,000, and right now we're 108,000. So we're back at about 2013 demand levels. It's down a lot off its peak, but as you just saw, it's not down enough to allow for the inventory to grow. The other metric that we're looking at for demand is closed sales. And again, let me, we'll start in the zoomed out view. You can see you have to move look at this. Look what happened with the number of closed sales. Obviously, this is COVID right here. This is March, April, May 2020. The massive number of transactions that happened and then the massive drop off afterwards. And with closed sales, we're back to mid 2013 levels, not beginning of 2013. So our closings were down 14% compared to last August. If I go back in and look at the single month data, we ended just shy of 11,000. Last August, we were at 12.5. So closed sales are down a bit, and it looks like that may be about to start to flatten out the same way the pending contracts curve did. This is always going to lag pending contracts by about 2 months or so, because that's how long it takes to close a contract. So the contract will tell us first what's going to happen with closed sales. Looks like it's probably going to start flattening out, and we certainly hope so. That's the one thing that's the biggest challenge, one of the biggest challenges in the market today. Months of housing supply, my favorite housing metric, has not changed. It's still 1.8 months. 1.8 months means that if new listings stopped coming on the market, how long would it take for buyers at the current pace of sales to buy up all the inventory that's listed right now? And that's 1.8 months. Now, if I were to extend this chart up by another couple of inches, we would eventually see, it would be off my computer screen, we would see the line that says 6. You can see over here, we've got 2, 3, 4 months of supply. 5 would be up here. 6 would be off the screen. That would be a balanced market. That would not be a seller's market as what we're seeing here. Housing supply has been stuck at this number, going all the way back to April 22, maybe March of 22, early 2022. It's been well over a year and a half. We've been hovering right around 1.7 to 1.9 months of housing supply, and that is a seller's market. Now, I poked around because sometimes, every little micro market's different. And I looked around and I can't find any individual MLS area in our multiple listing service. I'm not saying there isn't one. I just checked a bunch of them. I couldn't find any that were more than 5.2 months. 6 months is considered balanced. That means every MLS area in our entire multiple listing service is a seller's market at this time. So that wasn't the case for a little bit earlier this year, but that is the case now. Another measure that we're looking at for the supply and demand relationship is the number of days to contract. And you can see that also has been very consistent. It's still at 10 days. It's been that since July of 2021. July 2021, we've been at 10 days, 9 or 8 days that entire time. So it's still very much easier for a seller to do business than a buyer. And for those that are doing both, one of those is easier than the other. It's always going to be that way, just a question of which one. So then what does all this do to prices? Well, one of the weird things that we've been talking about in all these market updates is how when you see supply this low and market times this short and inventory at record lows, you expect to see prices skyrocketing like they did in 2021. But they stopped skyrocketing and they flattened out completely back in August of last year. So 12 full months ago, prices flattened out. And that's just because of housing affordability reaching different levels, mortgage rates obviously being a primary driver of that, but also prices having come up so much. If I zoom out here to a 10-year graph, that's a really, really rapid and steep climb that we encountered. And so this is just a bit of a correction as prices flatten out. But here's what's kind of crazy is that earlier in this year, we were seeing single-digit price drops compared to the same month the year prior. So, for example, January, prices were like down 1.3% compared to January 2022. We were seeing numbers between 1 and 3% lower, but taken a 12-month average, it was just flat the whole time. And it still looks flat on a 12-month average. But if you look at the monthly data, the median sale price in August was $312,000. It was 7.6% higher than last August. That's the third month in a row that the monthly pricing has been higher than the month the year prior. We keep doing that, and you're going to see that 12-month rolling average curl up as well. What this is saying is that prices are trending towards rising after a while of just being flat to slightly down. That is some pretty interesting news. Some people predicted that, others predicted something else. But that's what's happening. Is prices are starting to look like they're going to curl upward a little bit, which is really kind of interesting in light of our next point, which is mortgage rates. Now, let me flip over to this other tab here. I get my mortgage data from Mortgage News Daily for several reasons. But you can see, just to show you how volatile mortgage rates are, hours ago when I pulled this data, it was showing a 7.21% average on the 30-year fixed. And right now on the screen, you're seeing a 7.33. Well, whatever. So it's 7.33 right now. It spiked to about 7.5% a few weeks ago. And that was the highest it's hit in a while. And then it settled back down a bit. So here, if I shrink down this graph a little bit more, you can see just basically year to date, things have come up quite a bit since then. But here we were all the way up at 7.49% back towards the end of August. So aside from that spike, though, you can see that this is the 7% line right here. We've averaged at or above 7%, going all the way back to towards the end of May. So that's about 90 days that we've been at or above 7. And remember, I just told you that prices were increasing month over month. So this just goes to show people don't buy homes because of mortgage rates. It does affect their affordability for sure. It very much so. And that's why prices flattened out for a long time. But it's not the only thing. People buy a house when they have to buy a house. And if they're able to, because of their wages, their new job, their bonus, whatever, and they can pay more for a home to compete against other buyers because there's not enough homes available, they will. And that's how prices go up. So the fundamentals of supply and demand are still causing this low inventory seller's market, and any little flinch in anything that happens is going to cause prices to go up again, just like you're seeing, even though mortgage rates are quite a bit higher than they have been. I can zoom. Oops, let me move this toolbar back. I can zoom out a bit more, and you can look. Look at where rates are compared to the last 3 years. Prices are starting to go back up again in spite of that. That, to me, is notable information. Now, in terms of some of the other mortgages, other types of mortgages here, you can see your 15-year fixed is about 0.65 basis points lower, trading at a 7.7%. Your 5/1 ARM is above 7 itself. Then your government-backed loans are about a half point down compared to the 30-year fixed. FHA and VA are trading around 6.8. Again, all my numbers are wrong already. So 6.82, 6.85. You can see it right there. Let's talk about the Fed and the future of mortgage rates. So there have been a lot of interviews with Federal Reserve board members lately that indicate they believe they're going to hold the federal funds target rate at its current level, which is a 5.25% to 5.5% range, at their meeting in September, which is the 19th and 20th. They're not raising it again because they're seeing the signs that they like to see, which is inflation is still trending downwards. It came in at 4.2. The core CPI was 4.2% most recently. And the wage growth is moderating. Wage growth is a problem because it tends to really light a fire under inflation. And that's what we're trying to fight here. So if wage growth is a result of unemployment. So if unemployment is crazy low, then wage growth gets out of control, which causes inflation. And it's this huge chain reaction throughout the economy. It just takes a lot of time to slow that down without slamming on the brakes so hard that it destroys everything. So they're trying to accomplish that. They believe they're going to hold the rate at where it is in September. And a lot of people are thinking they're probably still going to do one more quarter point increase in their November meeting. But especially that's going to happen if any of those trends reverse. If inflation goes back up, if unemployment goes down, if wage growth shoots back up, they will absolutely do another rate increase in September. But there's not much time left for that to happen at the September meetings. They're probably going to hold there. So With all that said, what do you do? What's what should you take out of all this? Well, as I've been saying, a lot of this is repeating myself because real estate market cycles are not super fast. So a lot of what I say doesn't change dramatically from month to month. For sellers, of course, the advantage is still yours. Pricing is still pretty much flat, although depending, we might be looking at prices going back up a bit. So it's still important to price your listing very competitively. Now, buyers, if you go back and listen to any of these videos or read any of the reports that I've been saying for the last 2 years, I've been repeating myself the entire time about how you should probably not expect housing affordability to become more favorable to you and to improve in the near term. I keep saying it's going to be less expensive to buy a home today than it is tomorrow. And now you're seeing that despite mortgage rates being over 7% consistently, prices are going to resume their upward climb. So this is because the fundamental number of people buying and selling homes and the reasons for them doing so. Mortgage rates are a part of that market, but they're not the entire thing. They certainly hit your pocketbook, though. When rates go up a quarter or a half point, you can no longer afford that house that was at the very top of your price range maybe 2 months ago. Now, when prices and rates are going up at the same time, it's a double hit. And the longer you wait, the harder time you're going to have swallowing the pill of, geez, I could have had that house a year ago for a payment that was $250 or $300 a month less. So my advice to buyers is still the same, which is don't expect of housing affordability to improve or become more favorable to you in the near term future. At some point down the line, things will always fluctuate. But right now, the market fundamentals do not support an increase in affordability. And if you're on the fence or thinking about what to do, I would suggest getting off that fence. Follow us, subscribe to the channel here, check out some of our other videos, and always reach out to me any way that you want with any questions about your specifics. I'll look forward to hearing from you. Have a great one.